Welcome to the third video of Chapter 9. So in this video, we will go over the Blooper industry example. This is the most comprehensive example of discounted cash flow model in this chapter. So I put together the details of the Blooper industry example in a Word file. So let's start reviewing the details of this example. So Blooper industry is investigating an investment project, and these are the details of that project. So initially it costs $10 million. It costs $10 million for the initial investment, and that $10 million investment can be resold at $2 million in year 6. And the investment is depreciated in a straight line in 5 years. So this is basically a 5-year project, 5-year $10 million project. And in year 6, the company will sell the remaining asset and get $2 million for it. Then once the company makes the investment, that investment is expected to generate the annual revenue of $15 million because the company is expected to sell 750,000 pounds of ores per year, and price per pound is $20. So this will become $15 million revenue for each year. And here, the difference between this one and the slick razor case is that now we are considering the inflation. So the company expects the price of the ore to go up at the rate of inflation, and the inflation rate is expected to be 5%. So the revenue of the company will go up each year at the rate of 5%, starting from $15 million in the first year. The expected cost of the production is $10 million, and it is also expected to increase at the rate of inflation. So both the revenue and the cost will go up at the rate of inflation. Now, the next set of information is about the working capital. So the company expects the customers to pay with a 2-month lag. So 1/6 of each year's sales are not paid until the following year, which means that these 1/6 of sales is recorded as account receivable. So 1/6 of the current year sales will be recorded as account receivable, right? So this will be a part of investment in the working capital. And the second one is the inventory. So 15% of each year's expense represent the investment in the inventory that took place in the previous year. This means is that 15% of the following year's expense is this year's inventory, right? So inventory is 15% of expense in the following year, okay? And the last one is the required rate of return. So the opportunity cost of the capital for the company is 15%, and the tax rate is 35%. So using this set of information, we have to figure out whether this project is a good project or not using the net present value or the internal rate of return. Okay, so let's put together an Excel file. So this is the template that I created, and again, this is available on Moodle, so you can download it, and you can also look at the answers to this question on Moodle. So to review the template, as I told you before, we will put all the input parameters on upper left-hand corner here, right? And then we have the cash flow from operation here. We have cash flow from investment activities. We have investment in the working capital, and we have cash flow from operations. And when we combine all this, we get the free cash flow. So this is the free cash flow. Okay. So these are the parameters. So inflation rate is expected to be 5%, and the discount rate was 15%, and account receivable is 1/6 of the revenue of the current year, and also inventory is the 15% of the expense of the following year, right? And the tax rate is 35%. Okay. And from the question, we learned that the initial investment is a $10 million, so the unit is 1,000. So this is a $10 million. So when the company makes the purchase of a $10 million, company's fixed asset will go up by $10 million in the balance sheet, and the company's cash holding will go down by $10 million. So that's a cash outflow. Okay. In terms of the working capital, we learned that the working capital is made of current asset minus current liability. So current asset is made of inventory and account receivable, and current liability is account payable. So when you look at the working capital is the sum of inventory and account receivable minus the accounts payable, right? And inventory, according to the question, is the 15% of the expense of the following year. And we know that the expense in the first year is a $10 million. So it's a 15% of a $10 million, which is $1.5 million. In case of account receivable, we learned that account receivable is a 1/6 of the revenue of the current year. So in year 0, there is no revenue, so account receivable is 0. But in year 1, revenue is a $15 million. So 1/6 of that will be the account receivable. Okay. And there is no mention of accounts payable, so account payable we don't have to consider. Okay. So when you look at the working capital, in year 0, working capital goes up from 0 to $1.5 million. So change in the working capital is $1.5 million. And any increase in working capital is a cash outflow. So when you look at the cash flow, you can see that the cash flow is negative. So there's a cash outflow of $1.5 million. Okay, so that's the investment in the working capital. All right. Then the next part is the income statement and the cash flow from operation. So from the question, we learned that the expected revenue in the first year is a $15 million, and expected expense is $10 million, right? And the question also says that the depreciation is a 5-year straight line depreciation, and because the initial investment is a $10 million, so the annual depreciation is $10 million divided by 5, right? So we have to lock the reference cell and divide that with 5. So annual depreciation is $2 million. So once we have revenue, expense, and the depreciation, we can easily calculate the pre-tax profit. Pre-tax profit is revenue minus the cost minus the depreciation, right? So pre-tax profit is $3 million, and tax rate is 35%, which is recorded in here. So tax rate times the pre-tax profit will give us the total amount of tax. So net income is pre-tax profit minus the tax, which is the net income. So which is $1.95 million. So once we have the net income, we learned that the cash flow from operation is net income plus the depreciation. So net income plus the depreciation. So the cash flow from operation in year 1 is 3.95 million. And then we have to add back any kind of decrease in the working capital. And then we have to add back any changes in the cash flow from investment activity. Then we will get the free cash flow. Okay. But before we move on, we actually have to make another change for year 2 income statement. Right. The reason is because the question also considers the inflation. The question says that the inflation rate is 5%, and it also says that both the revenue and the expense will go up at the rate of inflation. So the revenue in second year is revenue in the first year, which is $15 million times 1 plus the inflation rate, right? And we have to lock the reference cell. In this case, we don't have to lock it because I named that cell as inflation. So the revenue in the next year is $15.75 million. We need to make the same adjustment for the expense. So expense is the previous year's expense times 1 plus the inflation rate, which is 5%. So expense will go up at the rate of inflation. However, in case of depreciation, the government does not allow the depreciation to go up at the rate of inflation. So the value of the depreciation stays constant no matter what the inflation rate is. So effectively what this means is that if there is a serious inflation, revenue and expense will go up, but the size of the depreciation tax shield will not go up. So the real value of the depreciation tax shield will actually fall. So that's something that we will talk about later. Now, once we set this up, then we know that the pre-tax profit is the revenue minus expense minus the depreciation, and all this rest of the calculation is exactly the same as year 1. So we can just hold it and drag it like this, and we can easily calculate the net income and the cash flow from operation. And once we set up the year 2 in such a way, then we can highlight the entire income statement and the cash flow from operation and hold it and drag it to year 5. Okay, so we can see how the net income will go up each year and how the cash flow from operation will go up each year. Okay, but before we move on, there's one last thing that we need to talk about, which is the salvage value. So when we go back to the document, right? When we go back to the document, the question says that there was a $10 million initial investment, but when the project is over in year 6, the company will resell that machine at the price of $2 million, right? So we have to go back and include that as a part of the sales of the fixed asset in year 6, right? So we can say this is a $2 million. However, one thing that we have to consider is that the company may have to pay tax for this one. So we are assuming that by the end of year 5, the book value of the asset will be equal to 0 because we assumed a straight line depreciation, right? So each year, the size of the depreciation is a $2 million. So the book value of that $10 million machine will go down by $2 million every year. So by the end of year 5, its book value will be 0. So when the company sell that machine, whose book value is 0 at the price of a $2 million, the difference between the market value, right? So resale value minus the book value, Actually, I should use this. So the resale value minus the book value is what you call as a taxable gain, which means for this much gain, the company has to pay tax. So in this case, the taxable gain is a $2 million. And we know that the tax rate is 35%. So when the company makes the sales of a $2 million, 35% of that $2 million taxable gain has to be paid as a tax. So the actual amount that the company will earn is $2 million times 1 minus tax rate, right? So the actual gain, actual cash inflow is a $1.3 million. So the cash flow from investment in year 6 is equal to this one. Okay. So when you look at the total cash flow from investment activity, in year 0, there was a $10 million cash outflow. Then between year 1, 2, 3, 4, 5, there was no investment in the fixed asset. There was no sales of the fixed asset. So all the cash flow was 0. And in year 6, there was a sales of the fixed asset and the company paid the tax. So after paying the tax, the net cash inflow was $1.3 million. Okay. Now we need to calculate the working capital of year 1. And inventory is the 15% of the expense of the following year. So today it's a $1.5 million because expense of the following year is a $10 million. So in year 1, the inventory will go up to 1.575 million because of the inflation. The expense goes up to 10.5 million. In case of account receivable, today is 0 because revenue is 0 and account receivable is 1/6 of the revenue of the current year. So in year 1, because the revenue will go up to $15 million, so 1/6 of that, which is $2.5 million, becomes the account receivable. So this is the amount of money that the customers owe to this company, right? So when you think about the total working capital, which is the current asset minus the current liability, so the current asset has gone up significantly. So you can see that the sum of these two is now 4.075 million. Okay, and once we understand all this, we have to calculate the changes in the working capital, right? Because what we want is the cash flow from the investment into working capital, and what we want is how much the working capital has changed over time each year. So initially the working capital in year 0 was 1.5 million, but in case of year 1, now it has gone up from 1.5 million to 4.075 million. So the change in the working capital is this year's working capital minus previous year's working capital. So change in the working capital was a 2.575 million, and the cash flow from the investment in the working capital is the inverse of it, is the negative of this value. So because the working capital has increased, any increase in the working capital is a cash outflow, right? So once we calculated the working capital in year 1 and the changes in the working capital and the cash flow from the investment in the working capital in year 1, then we can highlight all this and drag it till year 6, right? The reason why I include the year 6 is because there was an account receivable, right? So when the company made the sales in year 5, 1/6 of that is still owed by the customer, and customers will make the payment in year 6. So there is a cash inflow in year 6, even though the project itself is over in year 5. So it's very important to include the year 6 whenever there is a change in the account receivable or the accounts payable. Okay, so now we are all set with the cash flow from investment activity, cash flow from the investment in the working capital, and the cash flow from the rest of operations. So now all that we have to do is to add all 3 of these cash flows. So cash flow from investment activities. So I should do this. Sorry. So cash flow from investment activity plus cash flow from the investment in the working capital plus the cash flow from operations. Okay, so in year 0, there was a $10 million purchase cash outflow. There was a accumulation of inventory, which is $1.5 million cash outflow. So in year 0, the total cash outflow was $11.5 million. Okay, then when we hold it and drag it till year 6, we get all the cash inflows from working capital, cash flow from operation, and the sales of the fixed asset in year 6. Okay, and when we have that, then now we can calculate the net present value using the discount rate that was given here. Okay, sorry about that. So discount rate was 15%. And we are going to highlight all the future cash flows and then add the initial cash outflow. Okay, so we can see that this is a good project. So over that 5 year, the company will make the net profit of $2.77 million. Okay. We can also calculate the internal rate of return of this project. So internal rate of return is, we have to include all the cash inflow and outflow. And you can see that the internal rate of return is at 22.2%, which is obviously greater than the discount rate, which was 15%, right? So both the net present value and the internal rate of return agree that this is a great project. And when the company makes this investment, the expected annual return from this project is at 22%. And the total amount of the profit that the company is expected to make is at $2.77 million. One last thing that I may add is the modified internal rate of return. And in this case, we can change the assumptions on the reinvestment rate, right? So we highlight all these values, right? And the finance rate is the discount rate, which is 15%. So we assume that the company actually borrows at the rate of 15%. So opportunity cost of the capital is a 15%. And when the company makes money in the future, for example, in year 1, the company is expected to generate the net cash inflow of $1.375 million. And we assume that this $1.375 million will be reinvested at a certain rate. And here we can say that that rate is also the discount rate, right? Which was again 15%. In that case, we can see that the modified internal rate of return is about 19%. And to be exact, it's a 19.21%. So the difference between internal rate of return and the modified internal rate of return is the differences in the assumptions on the reinvestment rate. All right. Okay, that's it for today, and I look forward to seeing you tomorrow in class.